Good morning. This is Professor Marsh, and this is Chapter 6 in the textbook for Managerial Accounting at Newberry College in the fall of 2022. We're going to look at activity-based costing and compare that to variable and absorption costing, and find some additional ways to think in terms of how we might do that. So let's go ahead and get started. And the chapter begins with the introduction of 5 new learning objectives. One is to calculate predetermined overhead and total cost under the traditional method. That's sort of a review of the previous chapters. Then to describe and identify cost drivers. And we'll see that we're getting down to lower and lower levels and more detail in identifying different factors and metrics that can be used to allocate costs with these types of cost drivers. Then to calculate activity-based product costs. This is where we left off in class. And then the fourth objective is to compare and contrast traditional and activity-based costing systems. And then to compare and contrast variable and absorption costing. And the chapter begins with the example of Barry and Camille and their making their time budgets for their studying. And Barry makes broad estimates. He's supposed to represent the traditional method, and Camille is more precise, and that's supposed to represent the ABC, the activity-based costing system. So in section 6.1, which we did in class, it's a review of the traditional method, and the activity base for allocating costs is either direct labor dollars, direct labor hours, or machine hours. And one cost driver is used to allocate overhead throughout the production process. This works best for labor-intensive production processes. As technology replaces labor, the traditional method doesn't work as accurately. And see the example of Musicality and their recording machines beginning at figure 6.3. And you'll see an example of that. That's the traditional method used. That's the direct materials and direct labor cost for their 3 types of instruments or machines. The solo one, the band one, and the orchestra one. And you can see the difference in labor cost per unit. And what immediately you should see is that the labor cost per unit for the solo machine is considerably higher than that for the band or the orchestra. And I know when we discussed this in class, we said, well, maybe there's an over-allocation of costs to the solo instruments, but as we're going to find out later in the chapter, that was a mistaken impression by management, and that actually it turns out that the solo instrument is even less profitable than we thought it was. And you can see the traditional allocation calculation in that little green box just above figure 6.3. That is the formula that we use to determine our overhead rate that we're going to apply using the traditional method. So this is a good example of allocating overhead to the products using the traditional method, and we're going to use direct labor hours as the single cost driver. You can see that we do the calculation with that particular equation, and we end up with a cost of $2 per labor hour. We then look at the musicalities overhead and the number of direct labor hours per product. We have a total of 1,250,000 in total direct labor hours, and they break down between the solo, band, and orchestra as 350 for solo, 400,000 for band, and 500,000 for orchestra. We allocate the overhead using $2 per labor hour, and the overhead assigned to the product. You can see that, and then divided by the number of units, and we get a cost in overhead allocation per unit of $5 for solo, $8 for band, and $4 for orchestra. And so now we can calculate the total cost per unit, adding together our components of direct material, direct labor, and overhead. Our total raw material and conversion costs, and we have a cost per unit of $18.50 for solo, $16.75 for band, and $20 for orchestra. And then as we compare that to the sales price per unit, we can see the gross profit is $1.50 for the solo instrument, $8.25 for the band instrument, and $10 for the orchestra. So if you remember in class, I said, well, it looks like maybe the solo instrument production is being cheated, but as we'll find out when we look a little deeper, it's actually much worse than that, and certainly not what the first impression would be. So this is a way, as we look at the change in looking from the traditional method to the ABC method, perhaps we're going to be able to get some more accurate and precise information than we otherwise might think. In the Think It Through box, the gray rectangle at the end of the section, this is the key to the chapter. As technology changes and becomes more efficient, old allocation methods become obsolete, and they're more likely to underapply overhead. Why? Because the more labor-intensive activities are becoming they're changing to become less labor-intensive and more technology or automation based. And so we need a more accurate measure. So let's go into section 6.2 and take a look at cost drivers. So in section 6.2, we found examples of common manufacturing expenses and potential cost drivers. We went through this in class. You can see them. This is important to know and understand, and to really think this through as well. But you can find different types of cost drivers in many ways. If you think both creatively and also really understand the process, the step in the production process that you're trying to allocate costs to. So if you look at table 6.1, we're broadening the list of possible cost drivers for different steps in the production process. And cost drivers and overhead. In our next segment of this section, cost drivers can change as the manufacturing process changes. Some cost drivers may be per unit, some cost drivers may be per batch, some cost drivers may be per product, as opposed to the entire production process, which we use in the traditional method. And in this chapter, we're going to look at the cost pools per cost driver and attempt to allocate them appropriately. So identifying cost drivers. There is a segment in here that suggests that the first step is to analyze the activities in the product production process. An activity is any action that consumes company resources. And then look at how do the indirect costs vary? Do they vary by product, by inspections, by difficulty of assembly or packaging, etc.? And then you have the concepts and practice, cost drivers for small businesses, and you have the example of American Express, which actually consults with many small businesses, and there are consultants that go out and help the small businesses that take the American Express card. They say that all business activities are related to 5 main cost drivers, and you can see those listed at the end of the chapter. And if you think that through, I think that's a pretty good list. And you can see the assumption there. And I think American Express, a lot of their businesses are retail businesses with customers, and so perhaps that's a necessary overlay for that list. But the next section in the chapter is section 6.3. This is calculate activity-based product costs, and this chapter begins by telling us that ABC, which is how we abbreviate activity-based costing, is the process that assigns overhead to various activities that drive overhead costs. For many companies, overhead costs are now significantly larger than labor costs because of technology improvements. And costs can be gathered into cost pools on the unit level, batch level, product level, or factory level. And some indirect materials and indirect labor can be allocated separately on these levels and not according to the single cost driver allocation under the traditional method. And the book gives us an example of cleaning solution. So, it's different for the pop sockets that people use with their iPhones than for cleaning the potatoes that go into the French fries. Now, I don't know any businesses that make both pop sockets and French fries, but certainly those, if you had some kind of conglomerate that did both, those would be maybe pop sockets might be a premium and a Happy Meal at McDonald's now, and so McDonald's might possibly be making both of them if they did that internally. Anyhow, but with cleaning solution, you're probably going to have a different type of cleaning solution. It'll be applied differently and in different amounts in different production activities. So in establishing an activity-based costing system, you're given a 5-step process to identify the activities performed in the organization, determining the activity cost pools. Number 3, calculate the activity rate for each cost pool, allocate activity rates to products or services, and then calculate unit product costs. And that's a pretty good list. Now, I do have to say, when they go through some of the examples, they don't break those steps down exactly the same way in their examples. So you do have to do all 5 of those things, but sometimes when you see the examples that the author gives us, they combine some of those activities into a single calculation, or perhaps they skip over ones that are already assumed in the problem. So don't get confused by that. You can look at table 6.4 for examples of activities that can be grouped into separate cost pools. You're defining your cost pool as production, and included in production is indirect labor setting up machines, indirect labor costs of accepting and verifying orders, machine maintenance costs, and costs to operate the machine, utilities, and insurance. Now, what do you not see in there is you don't see anything that's not an overhead cost. So remember, we're only talking about overhead costs here. We're not talking about direct materials or direct labor. So these are not all the costs that are in that particular cost pool. They're just the ones, or they're not all the costs that relate to that particular activity. They're just the ones that are the overhead costs that appear to vary based on the same cost driver. So anyhow, so you're coming up with your cost pools. You're allocating them to different steps in the production process, and then you're going to try to find the correct metric, the cost driver that you can use for allocation. So, and that of course needs to be measurable. So, these are the activities that we believe most accurately are associated with the costs. That's the cost driver. They drive the costs. Okay, in your turn, at the end of the, after Table 5, which is the list of the cost drivers that were determined, we actually have a comparison of the company estimates to actual. Now, this is how management would be using this particular calculation, and the company compares the estimates to the actual and then analyzes the differences. So there were fewer machine hours, but also fewer overhead costs. So machine overhead was over applied, but material overhead was under applied because there were more requisitions than estimated. And so then we get down to calculation of product costs using the ABC allocation method. This is a longer example of the musicality company determining that they had 5 activity cost pools. They estimated the overhead costs for each pool. Then they estimated an annual activity rate for each cost driver spread by each product, and you can see that in step number 3. And then they calculated an ABC rate per activity, activity-based cost rate per activity, and that's number 4. And then they allocated the overhead costs to each product. And lo and behold, look what happened to the solo instrument. It's got a lot of costs there for a product that doesn't seem to be particularly profitable. And actually, as they go through now, the total overhead and the number of units, you see the overhead per unit. We see that when we get down to figure 6.9, that the solo instrument is actually a loss per unit. We're losing money on each one we make. We're losing $2.50 on every product we make. We're making $12.30 per orchestra instrument and 8.1 for the band machine, but losing $2.50 for the solo one. So we have to determine based on figure 6.9 and 6.10, what are we going to do about this? We're overall profitable, and we have to determine with our marketing and salespeople, does having the solo instrument available bring in band and orchestra customers? And if it does, then perhaps we have some alternatives for what to do with the solo instrument. Do we need to raise the price? Can we raise the price? Are we going to lose customers if we raise the price? What's the elasticity of that particular instrument in the marketplace? If we raise the price by $3 or $4 or $5 to make it profitable, is that going to solve the problem, or is that going to lose some band and orchestra sales, or are we going to lose so many sales that we're not going to be at break even with the price increase? Or do we use it as a loss leader to bring in the band excuse me, and orchestra customers. So that's a possibility. Or perhaps we discontinue making the product entirely. So that's also a possibility. So maybe we could license the solo instrument to another manufacturer who's more efficient, who could produce it for us. So there are some tough business decisions that have to be made based on this analysis, but certainly I think you can see that having more accurate information is helpful as compared to what we saw from the traditional method. And then the chapter, or this particular section of the chapter, ends with the discussion of service industries. They also can use activity-based costing systems. They can apply the same principles. Direct materials and direct labor can be minimal in service industries, and you can certainly use the healthcare example that is in that section to illustrate that. Now let's go on to section 6.4, comparing and contrasting traditional and activity-based costing systems. And let's take a look at table 6.6. And you can see that overhead in traditional versus ABC costing is compared in the traditional method. You have a single cost driver to assign overhead. In ABC, you have multiple cost drivers. The optimal usage for traditional is when direct labor is a large portion of the product cost. And for ABC, when technology is a large portion of the product cost. And then the orientation of traditional is cost-driven, and for ABC, it's process-driven. And as you can see, I'm drinking from my wife's coffee cup. ABC should give us a more accurate allocation of costs, especially when technology is more important than direct labor, and when non-manufacturing overhead can be assigned to a process or product or batch or even a unit. Even though you have a process cost system, you may find that for some costs under activity-based costing, you can allocate them per unit, as we did back in the job costing. Advantages and disadvantages of the traditional method of calculating overhead. There are three advantages of the traditional method. All manufacturing costs are allocated: direct materials, direct labor, and overhead. Secondly, all manufacturing costs are considered part of the product cost. Non-manufacturing costs are not considered part of the production process. They're treated as period costs. And only one overhead cost pool and only one measure of activity. It's a simpler method. The three disadvantages of the traditional method is: one, it's not as accurate. Two, it may misallocate overhead among different products. And three, and by the way, before we get to three, we saw an example of that with the solo musicality product. And then three, costs that are either period or product costs. It's acceptable for GAAP, but period costs may be also driven by products, and that's not taken into consideration. So it may be that GAAP accounting gives us less precise managerial accounting. And so I think that's what the author is trying to point out in calling it a disadvantage, because certainly if you came through financial accounting, things that were GAAP compliance were always better. Advantages and disadvantages of creating an ABC system for allocating overhead. There's four advantages. It's more accurate to use multiple cost pools. You typically find more accurate and allocation bases, measures of activity that are more important than direct labor or just machine hours. The activity rates may consider level of activity at capacity, which is not typically done for traditional. And both non-manufacturing and manufacturing costs may be assigned to products. So you may have some of the costs back in the front office or the showroom that vary by product, and you may be able to identify those and assign them to products, which gives you a better handle on how your costs vary by activity. Disadvantages are some manufacturing costs may be lifted out of the product cost. It can be more expensive, and more time and effort is needed to establish an ABC system and to maintain it. The practical impact on product cost, allows a company to shift manufacturing overhead costs between products based on volume. ABC costing can increase per unit costs of low volume products and decrease per unit price of high volume products. And the effects are not symmetrical. Usually the low volume products are hit harder than the high volume products are helped. And activity-based costing is not GAAP compliant. It doesn't show up in the published financial statements, which can be an advantage. So it doesn't give away secrets to competitors, which sometimes financial statements for public companies are digested not just among the users related to the company, but also analyzed by competitors looking to find out some of the secrets that their competitors might have. Let's go on to section 6.5, compare and contrast variable and absorption costing. Okay, variable costing is a system in which all variable costs are assigned to a product and all fixed overhead is expensed. It's also called direct or marginal costing. Absorption costing is also called full costing. It absorbs all costs into the cost of the product, all direct material, direct labor, and overhead. And so it ends up in inventory. Note the concepts in practice. The big three automakers, they would over allocate with absorption of period cost to inventory, producing more units, always lowered the cost per unit. But inventory would build up and period costs need to be paid, even if the cost is still in unsold inventory. And so they'd find themselves with no cash, but profitability, because they'd stuffed all their period costs into the cost of their inventory, capitalized and still showing up as an asset on the financial statement. And as the foreign manufacturers started to kick their butts in the marketplace, particularly the Japanese were so successful in the 1970s and 1980s, saw that type of accounting, that full absorption, which is GAAP compliant, unfortunately did not give them good information, and they had many serious financial problems, as the big three automakers, as a lot of unsold inventory sat on lots in Detroit. So matching, look at the expense recognition principle, can lead to fixed costs incurred much earlier but not recognized until the old inventory is sold off. And note the differences between variable and absorption costing. Figure 6.11, the difference in inventory costs or inventory volume at the end of the period. In 6.12, you see the same if all the units are sold. but it's different if some units are not sold. And it's a timing difference. You see that also in 6.14, and it's you get a very different timing of income between years 2 and 3 when you look at figures 615 and 616, which you can see down toward the end of the chapter, and there can be important timing differences. Now, at this point, what I'd like to do is to go to the quiz that we had for this chapter and see if we can go through the answers. I think you can see this, but I just wanted to talk through the Chapter 6 quiz. So if you'll pull out the quiz that you had, and let's take a look at one of the papers. These were all multiple choice questions. The first one was about tie-dye lights, and there are 2 products, and you were given all this information, and then the question was, using the traditional cost method of direct labor hours, what's the predetermined overhead rate? So this was just a question about the traditional method, and so we were given direct labor hours for the predetermined overhead rate, and so you just had to add together the direct labor hours for the 2 products and divide the total overhead by the total direct labor hours, and you got $2.15 per direct labor hour. That was the answer B, the second one. The second question, which is not a step in analyzing the cost driver for manufacturing overhead, and that was the last one, D, identifying non-value added costs is not a step in analyzing cost drivers. Question number 3, which of the following is a reason a company would implement activity-based costing? And the correct answer is they want to improve the data on which decisions are made. That's A. And question number 4, which is the correct formula for computing the overhead rate? And it's the fourth one, taking the estimated overhead for the activity and dividing it by the estimated use of the cost driver for the activity. Number 5, a company anticipates the cost to heat the building will be $21,000. Product A takes up 500 square feet of space. Product B takes up 200 feet of square. The activity rate per product using activity-based costing would be which of the following? When you've got 21,000, your only metric is square feet, so certainly square feet seems to be an appropriate way to heat the building and to allocate the cost. So you divide out 21,000 by 700 and you get $30 per square foot. That's the D. Okay, number 6, which is not a step in activity-based costing, and the correct answer is B, compute a cost rate per production. That would be the traditional method. So for 6, it's the second answer, B. For number 7, which is not a task typically associated with ABC systems, and just as in the previous answer, the one that relates to traditional costing is B, applying a single cost rate. Number 8, which statement is correct? And you can go through all of them. When you get to C, activity-based cost systems are more accurate than traditional cost systems. That is the correct answer. Then number 9, activity-based costing systems don't use the single predetermined overhead rate, don't limit the number of cost pools, they expand them. But C, they frequently increase the overhead allocation to at least one product while decreasing the overhead allocation to at least one other product. And we've certainly seen that with the example of the musicality company. Number 10, under absorption costing, a unit of product includes which costs, and direct material, direct labor, and manufacturing overhead is the correct answer. That's A. In fact, it allocates all of that to the products. Downside to absorption costing is, now, the correct answer is A, according to the test, but somehow I was moving around the answers, and I moved around the correct answer and put it last, that it is not well designed for cost, volume, profit analysis. So what I did is I gave everyone an extra bonus point, just about everyone in both sections. In fact, everyone in the first section got the correct answer, but it was marked wrong. So you all got an extra point for that. I don't think anyone actually picked the incorrectly marked answer A. So almost everybody picked D, which is the correct answer. It was a relatively easy question, just badly set up by the person who inputted the test, which would be me. Okay, number 12, last but not least, when the number of units in ending inventory increase through the year, which of the following is true? And the correct answer is C. Net income is higher for absorption costing than for variable costing. So that was your quiz, and we'll talk about the homework for number 6 at another time. But that's all for now. Good luck in studying for the midterm, and we will talk with you again as soon as we can. Thanks a lot. Bye-bye.